Welcome everybody to the Office Industrial Connection Show. Today I'm joined by Jeremy Goodrich. He is a commercial insurance broker, and I'll let him introduce himself here. But I'm Michael Tran, your host today, and we'll go over how insurance can affect many different aspects of your investment.
Absolutely, Michael. Thank you for having me. So a little bit about my story. I'm a serial teacher, I guess, is probably the best place to start. I was a third and fourth grade teacher for 13 years and really loved doing that, was in that world, and met my wife and business partner while I was a school teacher, and she's a third generation insurance agent. And so after a few years of us being together and those kinds of things, she was seeing sort of kind of the bad side of insurance, which is the side that insurance kind of gets the reputation, right? Sort of old boys club and taking advantage of people and not really trying to help people out. And so the two of us just decided that we would jump in, we would both quit our jobs and start Shine Insurance with the mission of really changing the way people feel about insurance. So trying to be a light in the storm, or whatever metaphor you want to use, and really come at it from the perspective of, let's educate people. Let's teach folks. Let's just be that teacher that I am and connect people with really good products and take it from there. And that's what we've done. So we've been doing this for 7 years. I've focused on real estate pretty much the whole time. At the beginning, I focused on first-time home buyers and then shifted to real estate investors of sort of single family duplexes and things like that, and moved sort of up the ladder into commercial real estate and have been doing that now for the last few years across the United States.
Nice. Yeah, it's hard finding honest people to work with nowadays. That's one thing that's very, very key for our team too. And when we're underwriting a lot of these buildings, a lot of people don't realize, hey, this insurance is going to affect the pricing that comes out on this deal. And sometimes people are underinsured. Sometimes people are saying, I'll just wait for a claim here or there to replace my roof, right? That's usually a big ticket item that a lot of people don't really think about. And then a lot of people just try to pass it on to the next guy or whomever. And so it's good, especially like with COVID now. I'm sure, they needed somebody very honest to work with throughout COVID to figure out, okay, how can you help me? I even heard about the Wimbleton, the tennis tournament. They had that insurance. I forgot the name. You can elaborate on that, but they had that insurance that covered them because it was cancer, and so that was something they were paying for. I think was it Ebola or something like that came out that they made. That's the reason why they got that coverage.
Yeah. So a couple of things you said there that I want to hit on. The first one is absolutely, I think insurance can kill deals, and especially in the environment we're in right now, where insurance is getting more expensive. We can talk about why that is and how to know the difference. And it's not affecting office and industrial and retail quite as much as it's affecting multifamily. But I think a lot of people are seeing insurance kill deals. And we can talk about how you can tell the real numbers and not necessarily just use seller numbers. But let me go into COVID like you talked about. You're exactly right. In March, there were a lot of business owners saying, does my insurance policy have coverage for COVID? And the most common one was a restaurant or a business that suddenly had lost tons of income because people weren't coming in the door anymore.
Yeah.
And the answer was no. Now, you brought up Wimbleton, and I'll talk about that in a second, but the answer for the most part was no. Your policies do have coverage for lost income. Every good insurance policy should have a coverage as a part of the property coverage for lost income. And that is if something bad happens to your building and you're not able to have your occupants, your tenants in that building for a period of time, we're going to figure out how much money you would have made off of tenant occupancy and pay that out as part of the claim.
Yeah.
And so a lot of people say, yeah, okay, perfect. COVID, you've got a restaurant. You can't make money off of that restaurant. That's exactly it. And the key to the difference is that the lost income coverage has to be connected with a direct physical loss to your property. So if a building burns down and it takes us a year to rebuild that building, loss of income coverage absolutely applies. We're going to make sure that we cover that lost income for that period of time.
Okay.
The problem with COVID was that there's no direct physical loss to your building. Your restaurant didn't have a physical loss to it. It was sort of a societal scenario.
Mm-hmm.
And so for the most part, COVID was not covered, and losses associated with COVID, unfortunately, are not covered. It's actually one of one of my YouTube videos that has the most views is answering this question that we just answered right here. So how did Wimbleton get coverage? Well, like you said, after Ebola, they realized that there was the potential for, I don't know the exact words, but disease, pandemic, whatever, could affect their ability to put on their competition. And so they purchased a policy. I believe that policy cost them $1 million a year to purchase this disease policy. And so are there policies out there that would cover COVID? Yeah. Is any normal person going to say yes to it as a part of getting an insurance policy for their business? No, it's just way more money than anyone would do. Now, I do think in the future, in the very near future, we will see more affordable policies that may address this topic even more because of how much people were affected by COVID. But prior to COVID, a normal business insurance policy, a normal commercial insurance policy doesn't have coverage anywhere in there. And if you had thought before COVID, well, I want to go out and get one, it would have been so expensive that you likely would have chosen not to purchase it anyway.
Oh, okay. Yeah. So that's interesting, actually. Like, that could be a really big mistake in a business decision. What are some really big mistakes that investors or people looking for insurance, what are some of the biggest mistakes that they, typically run into, and then they're like, oh man, this came back to bite me,
Yeah, I think one of the biggest mistakes is what we talked about right at the beginning there. Using your seller's numbers to underwrite a property. It just doesn't work, and there's a few reasons why. Some of the reasons price is the way it is volume. So if you are picking up a, multi-use industrial property, and it's your first property, and you're looking at a number and it's $10,000 a year on the seller's disclosure or the seller's documents, and you're like, okay, well, it'll be $10,000 for me. Well, that seller has tens of thousands of units across the entire United States. Yeah. Well, their per unit insurance cost is much lower than yours, right? And so that could be one factor that creates a problem there. Another is they could have $100,000 deductible. Your deductible is a key piece of your insurance premium, and you may be getting a loan that says you can't have a deductible higher than $10,000 or higher than $5,000. Mm-hmm. So that could be a key difference in the cost that you have associated. And finally, the biggest thing I see, unfortunately, is almost 80% of real estate investors have just really terrible insurance policies. And so it could be that the seller has an awful insurance policy that isn't going to cover them very well if something bad actually happens. It's all too common that people go down that road of just not caring what's actually on the policy, just wanting the cheapest darn thing they can possibly get. And so that $10,000 could be an awful insurance policy. So I think one of the biggest mistakes that folks make is trusting the seller's number and not going out to your agent and saying, hey, can you throw me some numbers for this scenario so that I have a better sense? Yeah,
that's actually one of the things we even have to overcome when we work with the seller, because they're like, well, these are my numbers. Like, why can't you get the price based off of this? And like, man, we have to underwrite based on how everybody else is going to look at this on a true numbers scenario. And so we usually have to do a lot of expectations that we have to manage. Saying, we can't use your numbers because you probably have this policy with this group that gives you this price. And, not everybody gets that. And so what are some really big things, I guess, for the Texas real estate market that a lot of people have to mitigate risk with? Like, what coverage is, because everybody thinks we have tornadoes here, but we really don't have that. I've been here all my life. I'm 29 now, and I've maybe seen one tornado.
Yeah.
So
Right. I think
some big things that everybody needs to look for in the Texas market.
it's a great question. Well, everything's big in Texas, right? And that includes hail. And so I think that one of the big things that insurance companies are scared of when it comes to Texas is hail. And so that would be the first thing I would see. What I'm seeing a lot in Texas right now is to protect themselves from hail claims. Well, let me ask you first. I mean, Michael, does that connect? Like, have you seen a lot of hail? Does that connect with you? And like you said, you don't really have that many tornadoes, but how about hail? Do you see a lot of that?
Yeah, we get a decent amount of hail.
Yeah. So I think that's the biggest thing insurance companies are scared of. And right now, one of the biggest things that's driving property insurance prices up is roof claims. And, you know, when it comes to property, especially investment property, there's usually a lot of roof. You know, there's a lot of roof, a lot of numbers inside those roofuses, whatever it is. You know, inside of those roofs. And so insurance companies have paid out huge claims, you know, and actually when it comes to investment property coverage, it's a pretty broad fact. So there's a lot of things figuring into this, but the last 13 quarters in a row, insurance companies have lost money on investment properties. And so a big part of that is roof claims. And so back to your Texas question. So Texas, they know there's a lot of hail. They're concerned about hail. And so they're concerned about hail claims. And as soon as there's hail anywhere, there's a bunch of roofers that show up and say, hey, I can get you a free roof. And so that dynamic, and I'm not saying anybody's right or wrong, that's just the dynamic of the situation, has caused a lot of insurance companies to not want to offer insurance in Texas. So that's one potential negative, is insurance companies just saying, we're out. We don't offer insurance here. The other thing you see a lot is insurance companies having a much higher wind hail deductible that is required than other deductibles. So in Texas, for example, a lot of times they have a 3% wind hail deductible. So if you've got a $1 million property, your deductible on that is $300,000. Wait, no, that's not right. Your deductible on that would be $30,000. 3% would be $30,000. So that's not so terrible. But, you know, you do need to be careful. If you got $20 million in property, suddenly that deductible is much higher. So I think that's the biggest Texas thing. And then when you get on the coast, coastal properties, insurance is much more expensive. But that tends to be, you know, within 50 miles of the coast. So that's not most of Texas. But some elements of Texas do have that exposure.
Are you talking about like Houston?
Houston is pretty different. Insurance companies take Houston differently because they are pretty close to the coast, but they're a little bit further off. So some companies feel a little more comfortable with Houston, and it's a little hard to say no to Houston because there's good opportunities there. I see insurance companies being a little bit more flexible with Houston than other places that are more coastal.
Sorry, I should have clarified. I only asked about Houston because it's like below sea level, or there's a ton of floodplain that's been built up on, and happy about it.
Yeah, I mean, that brings up the flood coverage, right? So flood insurance is an entirely separate insurance policy on pretty much all commercial policies. There are some insurance companies that will offer flood coverage as a part of their commercial insurance policy, but you don't see that as much. What you usually see is an entirely separate policy. So if you're buying in Houston, you've got to decide, do you want to pay for a flood insurance policy? And sometimes you don't get to decide because your lender is going to expect it. And I think as a realtor, you've probably experienced that before, where you've really got to prepare a buyer for the fact that flood insurance could potentially be a part of the deal. And again, it could be a deal killer depending on the cost of that and, you know, how it affects NOI and things like that.
Gotcha. Yeah. So we had before we had connected here, you had just wanted to discuss the triple net lease considerations or what to consider about those. Can you elaborate on that?
Yeah, I think the triple net lease thing is pretty interesting because from an insurance agent perspective, just with that hat on, not like with the real estate investor hat on, but from the insurance agent hat, I'm like, man, you're just handing over like the protection of your property to someone else. Like I get mailbox money. I get that, particularly with retail and franchise, you got a McDonald's in a building, you triple net it out, like money just shows up in your mailbox. You don't have to do anything. You don't have to deal with it. Totally get it. Totally understand. I guess that was my real estate hat. The insurance hat, I'm like, man, how do you, I just think, I guess the bottom line with triple net is two things. One, make sure you are named as an additional insured on that policy, which is usually in your lease and done properly.
Yeah.
Because that's going to mean you're going to get documents from their insurance company that show that they've properly insured the property. Two, I said two things. I'm going to say three things here. Two is look at that policy when you get that and have some bottom line sense of what those coverages are and make sure you understand them. If you've got an insurance agent for other stuff you're doing and that insurance agent is willing to check out that certificate to make sure they feel good about it, have your insurance agent take a look at it.
Yeah.
And then the third thing is I would still add that property onto your liability coverage. Because if something bad happens at that property, if it's a McDonald's and someone shows up outside and slips on some ice and, hits their head on the side bar thing and hires the local personal injury attorney and decides to try and sue everyone for everything they're worth, right?
Mm-hmm.
Well, of course, they're going to sue McDonald's, and that's McDonald's insurance policy. But that personal injury attorney is also going to sue you as the property owner.
Yeah.
And you need to have some protection for that. And if you've done a triple net lease and said, well, I don't need to have anything on my insurance policy for that property because it's all set up in the other person's name, that is just not a safe way to do it. That person's policy, even with you named, I won't get in the weeds. There's some people we could have a 2-hour argument about all of this. I just think it makes sense to add the extra $40 or $50 a year to your insurance policy to put that property on your policy for liability coverage only. It just is an additional layer of protection. If a building burns down and the tenant didn't have an insurance policy on it, well, that stinks. But, if you get sued for $10 million and you don't have any liability coverage, that's a whole different ballgame. Yeah. And so I feel strongly about the liability coverage on those triple net situations.
Yeah, that makes sense. So then not all buildings are triple net. So like a lot of the guys we deal with actually on the office side, same scenario, different situation here because not all these tenants are on triple net leases. So what should we consider there for the office, industrial, or even self-storage properties?
You mean when this is the property owner does not have a triple net lease, so they're insuring themselves for the building and the property and everything else?
Yeah, what should they look at? Because I'm sure people slip and fall in the buildings and stuff too, but what else do they need to watch out for? Because I'm sure there's a lot of first-time people who are buying something and they, just get the most basic coverage and don't cover everything.
Yeah. So I think the segue from the what we were just talking about to this is, my opinion of the best way to do it is to do what you're saying, which is keep the insurance yourself and then pass the cost on through whether it's lease or whether it's, there's different ways to pass the cost on, as and I really think that's the best way to do it because you have control of the insurance, but you're still passing the cost on to the other person. So when you're looking at insurance on a property where it's not triple net, you're in charge of it at all. There's 4 things that you want to have. One is enough coverage to rebuild the building. So, you could ask a builder, you could ask a realtor, you could ask a lot of people, what do you think it would cost to rebuild this building? Your insurance agent is going to have an opinion, and that's based off software that we use to kind of figure that out. Usually it's $100, between $100 and $150 a square foot for pretty common building in common places. But obviously if you're coastal California or if you've got a really high end property, that might be different.
Yeah.
So the first thing is making sure you insure to the actual replacement cost of that building, not what you bought it for. And, realtors have conversations with you that are market value and things like that. And that makes sense. It's about the money. It's about money exchanging. That's what realtors should be talking with you about. When you're talking about insurance, we're not talking about the market value. We're talking about what it would cost us to rebuild it. And I think that gets confused a lot, especially if you bought a property for $100,000 and it's a 10,000 square foot property. So the insurance agent is saying, well, we want to insure it for $1 million or something like that. It's like, I don't understand the relationship there. Remember, we're going to be rebuilding that property. And so that's what we have to insure for. So that's a big difference. So building coverage is one. The second one is coverage for your stuff. So if you pick up your commercial building and flip it upside down in your mind and shake it a little bit and imagine all the stuff that falls out, what of those things that fell out was yours? You want to have some coverage for that probably. Now, in a lot of properties, there may not be much. An office, you don't have a whole lot of stuff in there, but you may have a fridge, you may have a stove, you may have washers and dryers. Offices probably don't, but certainly multifamily does. Industrial, you may have things that you own in those spaces. Every different kind of asset class has the potential to have things inside the building that are not a part of the building, that are owned by the building owner. And, so you want to have some coverage for that. That's number two. Number three is loss of income. We already talked about that, right? With the COVID thing, that's when if something bad happens to the building and you cannot make money off of that building, that you have replacement money for your lost income. Super important coverage, not very expensive. So very cheap coverage when it comes to insurance and really valuable in a claim situation. And then the last one we just talked about, which is liability coverage, making sure if something bad happens to somebody slips and falls, and hires that personal injury attorney or is seriously injured, that you don't have to pull out of your pocket or your LLC's pocket or your business's pocket the money to defend yourself, to pay out a settlement, to pay out those injuries, to pay out that kind of stuff. Everything else in this scenario of the other three things I said is quantifiable. We know how much it would cost to rebuild a building. We know how much it would cost to replace our stuff. We know how much it would cost in lost income if we didn't have our building. But liability coverage is not quantifiable. There's no way to know how much someone's going to sue us for if something bad happens. And that's why it's so important to have solid coverage in that space. So those four things are what someone should be thinking about if they're taking care of the insurance on the building themselves.
Okay, yeah. So we just covered the core three product types. Is there anything you feel like in multifamily or self-storage that we should also consider?
Those core things are true for multifamily. They're true for self-storage. I mean, self-storage, they all have slightly different numbers that may apply. Multifamily, you may have more of your own stuff because you got a fridge and a stove in every unit. You're not going to have that in office. You're not going to have that in self-storage. Self-storage, you probably don't have very much of your own stuff, if any, at all. So you may have no need for business personal property coverage or coverage for your own stuff. As far as insurance, it always comes back to those four things. No matter what your asset class is, it's those four things. The difference is how your asset class handles those four things. So self-storage, I said you should cover your building for what it's going to cost to rebuild. Well, it's not going to cost $125 a square foot to rebuild a self-storage as compared to multifamily. These are vastly different building, things. So you can insure self-storage for less than you can insure multifamily. So there's things like that, but the four core coverages always stay the same.
Awesome. Cool. Good deal. Well, this actually, I had my own question. This wasn't in our original that we talked about, but what is one of the craziest claims you've ever heard?
So, I mean, funny, I'll do funny and then not funny at all. Funny is, probably the funniest claim is there was a client of mine who had a tenant and it was Thanksgiving, and this tenant decided that they wanted to make a turkey. Well, that's pretty common. We all want to make turkeys. Right. But this particular tenant wanted to make a deep fried turkey. And if you have never heard of deep fried turkey, the basic premise is you take a very large vat of oil and you heat this vat of oil up, and then you drop a turkey into the vat of oil, and the turkey cooks for, it's very short. It's like half hour, 45 minutes instead of 5 hours or whatever it is in the oven. Yeah. and it's super yummy. It's really good. It's awesome.
Yeah.
Downside, if you do one of multiple things wrong, you put in a frozen turkey instead of thawing it first, or you overfill with oil, then you create a grease fire. So essentially you create a grease fire. It's very easy to create a grease fire. So if you're the type of person who wants to deep fry a turkey, I would suggest doing it outside in your driveway, somewhere safe, where if there is a grease fire, it's not going to burn your house down. But in this case, the tenant did not do that. They decided to deep fry a turkey on their kitchen stove, overfilled it or didn't thaw it. I don't know exactly what mistake they made, but ultimately had a grease fire. Fortunately, didn't burn the entire place down. No one was hurt. That turned out to be about a $50,000 or $60,000 claim, even though they got it under control pretty quickly, because the entire building was affected by grease smoke. And so the actual flame damage was not as costly as the smoke damage associated with that particular scenario. So there's no exclusion on insurance policies for stupidity. That's an example. And so that was good. And then probably the craziest, claim I've had that was different was also a fire, but people, with students at college, and some folks didn't get out, and it was really, really ugly and really awful for everybody involved. And it was, I was blessed to be able to walk that property owner through that situation.
Yeah.
But nobody wants to go through that, and nobody wants to experience that.
Yeah, that is sad. Actually, there was one that I did hear that I thought was very out of the blue. So, we call a lot of people, see how their property's doing. The one tornado I've been through, I crossed the path after it had been through this certain area of Dallas. And it had just gone across the whole highway, shut it down. All these 18-wheelers jackknifed and everything. Just signs everywhere. You could only get through one way. There's probably 5 cars with the jackknife 18-wheeler on the side. So, we're calling a lot of these guys to make sure they have some type of lease amendment or something they can do with their guys. And so one group I didn't get to in time, I called him probably about 3 or 4 months later. He had bought this, I want to say 30, 40, 50,000 square foot facility. It's not income producing. He bought it, was just going to, try to lease it out. And they had to pay him for replacement costs. But this area, a lot of the stuff was lower price per foot just because, one, the market, two, the type of building, it's an industrial building, but low ceiling, so not as desirable. But they still had to pay him to replace the cost of the building. He buys it for $2 million or so, and replacement cost on this deal was, I think, $11 million.
Huh. Yeah.
And so he basically hit the lottery, and he's like, "Man, I'm done. Like, I don't have to do anything anymore." And I was just like, "Yeah, I can't argue with you there." So that was probably the most interesting commercial insurance claim I've heard thus far. But yeah,
and I think for that, it depends on the insurance policy, but a lot of people, it looks like it turned out pretty well, and that's an example of replacement cost. A lot of people say, "Do I have to rebuild it if something bad does happen?" And the answer is no, you don't have to rebuild it, but different insurance policies can penalize you in different ways if you don't rebuild, and pay out less. So if you're thinking about insurance and you're thinking about, hey, I don't really want to rebuild if I had to, just make sure you understand the policy and how it would actually pay out. Sounds like that person's policy was a replacement cost policy, probably had it set up in a way that if it was a total loss, they would figure what the cost to rebuild that building was and pay that number out and wipe their hands and move on with their life. I would say that's the best kind of policy, and there's lots of other kinds that don't do that, though.
Awesome. Well, Jeremy, thanks for joining me today. Can you let everybody know how to get in touch with you, your website, phone number, everything?
Yeah, absolutely. So I said at the beginning that 80% of insurance policies are terrible and not very good. And I know this because I review a lot of people's insurance policies for them and talk it through and then show them what we can do at Shine. So I decided to create a really easy sort of quiz to know if you're one of those 80% of people who have terrible insurance policies. And you can find that at shineinsurance.com/REI. So real estate investor. So shineinsurance.com/REI. You can take that quiz. And, that'll get you connected with us, and then we can talk from there. So I would say that's the single place to connect with us. And, all other contact info is in that same space, and more than happy to chat with any of your listeners and talk about, all the exciting elements of insurance.
Yeah, good deal. Well, yeah, thanks again for joining us today.